Good morning, dear participants to EIOPA Sustainable Finance Conference. A very warm welcome. My name is Pamela Schuurmans. This is the 7th event on sustainable finance, the 7th conference that we've been hosting since 2018, and it comes again at the right time. After eventful days at COP28, a provisional deal reached between the Parliament and the Council on the CSDDD, and again a record heat summer. We have a full agenda with high-profile speakers today on hot topics. A short introduction on how the event will go. Today you will again have the opportunity to use Slido for asking your questions. We will also use the opportunity for some Slido polls to engage with you. And in order to test how you operate the Slido, we have a short question for you, which we would like to launch now while I'm introducing the plan of the day. So while you're testing and while you're responding to the word cloud on the main opportunities to achieve decisive progress on sustainable finance by 2030, please go ahead. Hashtag of today's event, EU Sustainable Finance. So you can try it out. And while you're testing that, I would like to briefly introduce to you the program of today. We have, before the coffee break this morning, we have 3 high-profile key speeches by the Chairperson of EIOPA, Petra Hielkema, by the Director for Financial and Enterprise Affairs of the OECD, Carmine Di Noia, and by Shigeru Ariizumi, the Vice Minister for International Affairs at the Japan FSA and ex-co-chair of the IIS. After a short coffee break, we will then resume with an impulse speech by MEP Paul Tang and a panel discussion on sustainability disclosures. Following the lunch break, we will then have 3 topical sessions on very worthy issues. One will be the one of coordinated climate scenario analysis that we're conducting across the financial sector. The second topic will be an interview with the NGFS Vice Chair on the Task Force on Nature-Related Risks will be Mark Reinke on nature-related risks. And the third topic will be natural catastrophe knowledge sharing. And we hope you will enjoy this event. I hope you've also been able to test Slido in case you're willing to. I'm not sure if the votes are very telling yet. We have a few participants. Let me see. What are the main opportunities to achieve decisive progress on sustainable finance by 2030? At the core of your responses, it seems to be very important to collaborate. And I think that is a very good introduction to the keynotes today, because we have representatives of various institutions who actually collaborate on the climate change challenges, but also on social and governance issues. So we hope you will enjoy this event, and we can get back to the poll later on also, maybe for the concluding remarks. So without further ado, I would like to introduce to you Petra Hielkema, with little introduction needed, the Chairperson of EIOPA. Petra, the floor is yours.
Yes, thank you. Thank you, Pamela. Thank you, everyone. I hope you can hear me well.
Yes, we can.
Excellent. Thank you. So thank you all. Thank you for being in the call. You make me a happy person this morning, seeing that I think so many familiar topics are on the slides that you just responded to in Slido, but collaboration is one of the largest one. I think that is exactly what we need to do on a new but very urgent topic as a supervisory community with our industry. So thank you for also joining her today. We hope to share a lot. We hope to hear a lot. We hope we all can learn a lot. And so a warm welcome to all of you. It's just a few weeks ago, actually, that we had our annual conference where we also in general discussed the risks that are there for the insurance and pensions industry. And of course, you will not be surprised if I say that tackling each of them was listed as important, but also requires transformational transition. And the resilience of our society is at stake whether it is managing the growing costs of climate-induced catastrophes, whether it is narrowing the cyber insurance protection gaps, or whether it is dealing with an aging population and the need to have a reasonable, at least reasonable life in retirement in Europe, but I know also elsewhere in the world. These are important challenges. And when it comes to the challenge of climate change, the recent COP28, I think, showcased how difficult it is to implement global commitments to get to effective and deep emission reductions. But without such reductions, we will not meet the goals of the Paris Agreement. And so I'm happy that at least we made some progress. We saw some progress in COP28, but now we need to again move to implementation. Not a new message. Sometimes it sounds like a broken record. There are gaps in both our ability to adapt, the speed with which we adapt, the speed with which we mitigate, but also how we finance the transition. And so talking about scaling up investments but also scaling up mitigation measures, adaptation measures, I think is essential. And it is important that we do that, and this is near to my heart, that we do that remaining very pragmatic and focusing on solutions. And so this is why I'm very pleased to be here today also to discuss with you a little bit on what we can do to move ahead from policy to implementation to supervision. Let's start with that policy. Resilience policy making requires regulation that is future-proof, that is actionable, and that is coherent. And there is a challenge for increasingly horizontal regulation, which I think makes sense, and it is accounting for a range of possible future outcomes. It should not contradict each other. It should preferably build up on requirements that are already there. But how can we achieve this? And the regulatory burden on the economy, and the financial sector is not small. But you will be pleased to hear that regulatory efforts on sustainability risks for the financial sector, and there were a lot, they are starting to come together. And I think going forward, we will see while we implement that is happening more. Insurance and investee companies will start reporting under the Corporate Sustainable Reporting Directive, the CSDR in the EU. And the sustainability disclosures are an opportunity to assess progress, to manage risks and direct investments towards more sustainable goals. We're getting there. And EIOPA has recently also released its final advice on regulatory technical standards for the SFDR that already is in force, the Sustainable Finance Disclosure Regulation. And we will continue to contribute to transparency on sustainable investments as part of the Commission's efforts to improve the SFDR. And we will ask our panelists today to discuss what is needed to make sustainable disclosures work in practice. Very important panel. We have SFDR, we have CSDR, we have industry implementing. There's a willingness to be transparent. But how do we bring that together? How do we put that into practice? What is helpful? What needs to improve? Let's talk about that. Now also, the expected amendments to the Solvency II directive aim to strengthen requirements for climate scenario analysis and will require EIOPA to investigate how nature-related risks are also accounted for in the ORSA. As you already know, climate-related risk is already in the ORSA. Now we see a next step with nature-related risk coming in. Legislators really recognize the need for appropriate capital charges for natural catastrophe risks and for insurers to assess the financial risk arising from the transition. And these are steps that we have been anticipating, and we stand ready to support the industry in implementing this. The Corporate Sustainability Due Diligence Directive is also being negotiated, and here we can see an increased focus on transition plan from a risk-based and due diligence perspective. And although we feel that it is important that the financial sector is recognized in its role to contribute to sustainability, risk mitigation, adaptation. It may be that at least at first they're not part of that corporate sustainability due diligence directive. Let's follow the discussion. But regardless of that, I think having a transition plan, thinking about the transition will be a need. And for sure, transition plan, prudential transition plan, I expect that to be a part of Solvency II. But I'm sure that someone who knows this much better than me, Paul Tang, who will speak later, and thank you, Paul, for being willing to do so, he will be sharing some insight on the latest legislative developments in these areas in the speech today. And I think there's some news to share as well there. So that's on policies, and policies, the efforts are the right ones. There's been a lot, but I truly feel it is coming together when we move to practice. So let's now discuss that, the move to practice. And on the areas where we have been moving to practice a lot, I think, is in tackling insurance and protection gaps for natural catastrophes. Our NatCat dashboard that we issued last year, we have been updating that now, but it was welcomed a lot. And so the update now in 2023 is not showing much improvement. It still shows that about 1/4 of natural catastrophe losses is insured, meaning 75% at this moment is not covered by insurance, but will happen. We can expect it to happen, but we don't yet have an organized plan to deal with those losses. So the extent of damages to properties and to livelihoods is actually becoming a chronic physical risk problem for the insurance sector, but also for society, and in the absence of a mechanism to deal with those losses, also for governments, and therefore possibly for financial stability. And as climate-induced events become even more severe, insurance can become either more costly or unavailable, and the protection gap will widen. So the smaller the progress on mitigating greenhouse gas emissions, the more we will need to do in terms of adaptation. And we all know that prevention is always less costly than the cure. And this is why we need to invest in adaptation measures. And here, insurers really have a role to play. But at the same time, the role of supervisors could not be more evident. And so this time I'll focus on the role of the supervisors. It is the role of supervisors to preserve financial stability by improving the sector's overall capacity to handle the economic consequences of NatCat events. Supervisors have the explicit mandate to secure consumers are protected and fairly treated. And supervisors can also support financial inclusion and market development by making regulatory efforts for access to affordable and appropriate insurance by underserved segments of the society. And so EIOPA has been analyzing factors that hinder consumers from buying insurance coverage against NatCat risk. And we are also developing tools to raise consumers' risk awareness, building on our work on impact underwriting. Based on the evidence of the gaps and their root causes, EIOPA is engaging with supervisors and governments on potential policy measures to be taken to reduce the gaps. And we're also thinking of how potential measures at the EU level could look. Adaptation and prevention measures must be at the core of the shared resilience solutions going forward. That's what we've been saying. That's also what we hear coming out of COP28. This is now where we need to start doing that. And so also the recent publication of the IIS puts into evidence the areas of activity in which supervisors can and shall engage to tackle NatCat risk and to tackle the tackle NatCat protection gap. And you will hear more about this from my very distinguished colleague, and I'm really happy he was willing to be available today, my dear colleague Shigeru Ariizumi. It's a pleasure to have you also speaking at this conference and allowing me now also to thank you not only for doing a lot of good work on the protection gap in the last year, but also your willingness to take on the role of the IAS chairperson. Now, a second area where we are moving to practice is in securing the management of sustainability risk by insurance and occupational pensions institutions. Solvency II already imposes requirements on insurance to manage sustainability risk as part of the ORSA. I just mentioned that. Nature risk will come with the review of Solvency II probably into the picture as well, but we already have sustainability risk as part of the ORSA. And we expect actually that that is further cemented into Solvency II also for climate in the reviewed Solvency II. Starting next year, EIOPA will monitor the implementation of the insurance industry's sustainability risk assessment as part of the ORSA, and we will be engaging with supervisors on how undertakings have been implementing transition and physical risk assessment in that document, and where relevant, how they perform dedicated scenario analysis. And this will lay the basis for identifying good practices and potential guidelines to support the analysis of financial risks related to transitions. On pensions, our advice on the EIOPA directive for the Commission this year was to require EIOPs to likewise account for sustainability risk and the resulting adverse impacts in their investment decisions. As a significant institutional investors, because that's what pension funds are, they have the power to further the green transition. Now, you may already have seen our recently released consultation paper on the prudential treatment of sustainability risks. It went out yesterday. It's already a lot of communication happening on that. It is a milestone. But we really look forward to hearing the views from stakeholders on our proposal. This was a document that we really carefully worked on. We extensively debated, also in my board, with the 27 member states. And it is now at the point where it needs the input from stakeholders. So we really look forward to hearing from you. We will also further develop our approach to nature-related risks, and at today's conference you will hear more about nature-related risks for insurance later today. You will also hear later today more about the coordinated climate scenario analysis that will be conducted by the ESAs, the ECB and the ESRB in 2024 to shed a light on the risk and opportunities for the climate transition in the financial sector, and also possible contingency between the different sectors. Now, this is a very special and I think a huge exercise to have the entire financial industry with EBA, with ESMA, with EIOPA, with the ECB, with the ESRB, actually assessing, if I say it high level, the Fit for 55 package and the impact of that transitional risk on the financial industry in Europe through this scenario analysis. And we will be doing that between now and beginning of next year, hopefully communicating some outcomes in the second half of next year. Now, the third area of activity, that is really sharing knowledge on data on catastrophic risks, sharing also knowledge on how to work with those data. And so EIOPA really supports open access to data and modeling to improve sustainable risk assessments. Here we really need to cooperate and share solutions, share data. And as a center of excellence in data and CAT modeling, EIOPA will support European supervisors and insurers with expertise, with studies, tools, and data. For this will enable the supervisors in Europe, my supervisory community, to assess and supervise these risks. And therefore, today we will release the Catastrophe Data Hub. And we will do that online, and that should facilitate the view of European insured losses and exposure data related to catastrophe risks. And we will tell you more about that. So this is a bit of a teaser. Stay tuned, you will hear more. Now, fourth, we need to progress in securing trust in the transition. Address greenwashing is therefore, I think, essential. It's an antidote against increasing climate despair, but also a key to securing progress in transition. We all need to be green, but can we trust when something is said to be green? So we are working with very high priority on identifying how to support the reliable green claims, both at the entity and the product level. Where commitments are made, they need to be honored. And we will be publishing an opinion soon, setting expectations on how supervisors should look at sustainability claims. And we are working on guidance for sustainable product identification. And here I very much look forward to, again, a great colleague of mine, Carmine Di Noia, to also be with us today and to share his views on how due diligence and business conduct can incentivize not only the management of financial risk, but very much also the impact on society. Now I'm coming to an end of my remarks, but I hope I have been able to show to you how through very concrete action, EIOPA aims for the insurance and occupational pension sector to continue to protect society for the long term. What matters is now how swift we implement, and that we can discuss today. So I really hope you use Slido to ask the questions you have. I really hope you stay tuned for the many topics I just touched upon. And I really hope that at the end of today, we all can say we are a little bit wiser, and we are very much also full of energy to get this done. I wish you an enjoyable conference. I hope you get a lot of inspiration, and I hand the floor back to you, Pamela.
Thank you very much, Petra, for these insightful remarks. And without further asking questions, you will not receive Q&A from the audience, Petra. Voilà, so you're safe from that. And I would like now to introduce the next keynote speech by Carmine Di Noia. Carmine is Director for Financial and Enterprise Affairs at OECD, and we're always very happy to engage with OECD on sustainability. So we're very happy to have you speaking at our conference. Carmine, the floor is yours. Thank you.
Thank you. Thank you, Pamela. I hope you can.
Carmine, I think your audio is not working yet. Not yet. It was on very briefly, but
Let's see.
Perfect.
Okay, can you hear me now?
Yes, we can.
Okay. Sorry for that. Obviously, for Murphy's Law, yesterday my computer was changed, so we had tried. But thank you for this invitation. It's great to be here. Thank you, Petra, also for the mention and also the introductory remarks. And I'm always happy to interact as also in the past in different roles with ESAS and with EIOPA in particular. I think this is a very important event today. And I think, as also in part was mentioned by you, Pam and Petra, I would like to focus also. We had some legal acting in concert in preparing these speeches. So to an aspect which I think is important and is complementary, which is basically we'll focus in particular on a recent OECD and G20 OECD standards, the new principles of corporate governance, and why they are important. But actually, before doing so, I would like to mention some capital market trends and the key role of institutional investors. And then also I would say some words on the OECD work on private pensions, with asset-backed pensions being one of the most important players in today's equity market, and is always great also to have EIOPA also participating in our work and collaborating with you. I mean, one thing. Let me start by emphasizing the critical role that institutional investors play in today's capital markets. Capital invested into the real economy in particular by the insurance companies and pension funds, given that we're here at EIOPA, helps support innovation and job creation while providing households with a way to participate in corporate value creation. So it's a supply and demand issue, as we always say. So over time, most advanced economies have seen a growing dominance of institutional investors as direct ownership by individual household has decreased. Obviously, the ownership of institutional investors comes from direct and indirect participation directly by households. So this is an intermediated part. Now, institutional investors are the largest owner in the almost, we have around on the back of the envelope 44,000 listed companies in the world. And the institutional investors hold around 44% of the total value of global listed equities. Now, the equivalent figure in the EU is somewhat lower, is around 36%, while in the US is as high as 70%. Now, institutional investors are not only important at the market level, but also hold significant stakes at the company level. And this concentration is partly because institutional investors' asset allocation is index driven, and that indices favor large companies with high free float levels. So big institutional investors, including insurance firms and pension funds, they own, let's say, a lot. And the tremendous growth in assets under management by institutional investors during the last 2 decades, and the decreasing number of listed companies, in particular in OECD markets, we had 30,000 companies that left the market gross, have also contributed to this trend. And obviously, insurance companies, and the big one, are also part of big financial groups with big asset managers. Now, to give an example, between 2005 and 2022, over 8,000 companies, actually, I told you 30,000 in the world, 8,000 delisted from European exchanges. And basically, these, if you have more money that goes on big companies, you have less companies on the market, this results in a growing amount of capital allocated to a decreasing number of companies. And this is why we see that in the EU, the combined company level holding of the 3 largest institutional investors is actually more than 15%, 16% on average. In the US, the ratio is even higher, 26%, nearly the double. Now, due to the liability structure, actually, insurance corporations mostly focus their investment on fixed income instruments, with around 10% of their assets invested in equity market. Because of their sheer size, that still makes them important players in the global equity markets. Pension funds are even bigger players. According to our also the recent data, at the end of 2022, asset-backed pensions in the OECD held assets which were 48, nearly $50 trillion, of which an average of 30% was held in equities. Now, because most of these assets are invested in diversified portfolios in foreign markets, so it's important to have global standards that reflect these changing dynamics in global capital markets, and provide a coherent and consistent framework to help corporations and investors operate across borders. There is a famous quote by Paul Krugman, a famous international economist, saying that in a world of globalized finance, and quoting, having common international standards is like having traffic rules on the road. It ensures smoother and more predictable interactions, fostering trust and stability in the global economic system. And trust was also mentioned before. Now, that's why I want to talk to you about the G20 OECD principle of corporate governance. Now, governments at the OECD and G20 and FSB joined together to set many of such global standards. And we have, we're lucky to have a good table here in Paris. Why I'm talking to you about these standards? Now, first of all, many insurance companies are also big companies and are listed companies, so to which the principles apply as listed companies. But they are also on the other side of the market themselves and in their group as asset managers and pension funds, because they also invest in other listed companies. So insurance companies are often major shareholder of the typical company that should abide by the principles. And again, themselves, they have to apply. So ultimately, the principles are addressed to you, to this audience, or are important for supervisors, and are highly relevant as investors to insurance firms, both passive and active, but also, and this is the other, I would say, pillar, in stewardship roles as asset managers. Now, the G20 principles of corporate governance help policymakers, they are addressed to policymakers to evaluate and improve the legal, regulatory, and institutional framework for corporate governance. 53 jurisdictions formally adhere, plus many others, also through the different regional roundtables, Asia and Latin America. And they are widely used as a benchmark by countries around the world. Also important for you is that the G20 OECD Principles of Corporate Governance are one of the Financial Stability Board key standards for sound financial systems, and also provides the basis for assessment of the corporate governance component actually by the World Bank. Now, the principles are also used as a benchmark in developing sectoral corporate governance guidance by other international standard setting bodies like the Basel Committee of Banking Supervision, and we have also discussed with our friend also Shigeru many times. Now, given their important role, the principles are regularly reviewed to ensure that they remain the global standards of corporate governance. By the way, this is the new edition, so I have to sell my carpet. Now, the latest edition of the principles was launched in September this year after approval by OECD ministers and G20 leaders, and a long work by the Corporate Governance Committee chaired by Deputy Finance Minister of Japan, Masato Kanda. The principles, this is important. We see corporate governance as having three strategic objectives. Namely, the first one is to promote access to finance, then to provide a framework to protect investors, actual and prospective investors, and also, and that's relevant for today's discussion, to support corporate sector sustainability and resilience. I will present some of the main recommendations to address these objectives, followed by some comments on the role of the principles, also in ensuring the accountability of board members and executives. Now, on promoting access to finance, good corporate governance promotes access to finance, particularly from capital markets. Good corporate governance makes other things being equal, as economists say, makes access to finance cheaper by making business conditions more attractive for both companies and investors. And this promotes innovation, productivity, and entrepreneurship, and more broadly, so economic dynamism. And as capital markets and so capital flows are more and more global, luckily, due to the integration of financial markets. So having an up-to-date global corporate governance standard that supports access to finance is crucial. Okay, the principles, I will now go a bit quicker, include many new recommendations to address these trends, to promote important for you. Typically, again, insurance firms are in groups, so clear regulatory framework for company groups. They recommend that also jurisdiction develop definition criteria for the oversight of such a structure. They also, reflecting the growing importance of institutional investors, they encourage using stewardship codes to promote shareholder engagement, strengthening institutional investor disclosure of their engagement and voting policies. They also address for the first time heavily the increasing importance of bondholders in markets and implication for corporate governance. And finally, again, important maybe for you, they reflect the increasing use of these information intermediaries, I call it technically, proxy advisors, index providers, ESG data, and ratings and scoring providers. So they aim to minimize conflict of interest that might compromise the integrity of their analysis and advice, and to promote transparency of their methodologies for rating and indices. Information intermediaries, which often also you rely on for insurance firms for their choices. And in addition to widen access to finance, the principles also recommend flexibility and proportionality for smaller listed companies and different circumstances. Now, investor protection, this is a second important aim. So they provide a framework for investor protection. Would it be households, pensioners with investor savings, or even buyer of insurance products? This is very important. It's important to ensure also the equitable treatment of the different categories of stakeholders, in particular of shareholders. And so there are basic rights to access information, guaranteeing also proper oversight and disclosure of related party transaction, ensuring effective enforcement against, insider trading, other violation of shareholder rights, ensuring disclosure that provides investors with quality information to support their assessment of a company value and investment or voting decision. There are also new recommendation on general meetings or remote shareholder participation, right of minority shareholder, and so on. But let me say that now focus on the third objective of good corporate governance is support corporate sector sustainability and resilience, which in turn contributes to the sustainability and resilience of the broader economy. And this has led basically to the biggest overall change in the principle, a fully new chapter, chapter 6, on sustainability and resilience. Basically, the new recommendation focus on three major issues: the disclosure of sustainability-related information, the responsibilities of the board on sustainability matters, and the dialogue between a company and its shareholders and stakeholders on sustainability. On disclosure, the principles provide guidance on the concept of materiality. They support adherence to internationally recognized standards that facilitate the comparability of sustainability-related disclosure across company markets, and we obviously work very close to the international standard center. They aim also to ensure that verifiable metrics are disclosed if a company publicly sets a sustainability-related goal or target. And finally, they recommend the phasing in of external assurance to provide an objective assessment of a company sustainability-related disclosure. When concerning the responsibilities of the board, so the recommendation clearly states that board should ensure that they also consider materiality sustainability matters. The principles promote also the dialogue between company, shareholder, and stakeholders on these. And beyond the principles, we have also developed, and we presented the COP28 last week, at the beginning of last week, a paper on to support, the net zero metrics, and this is very important because incentivizing improved data disclosure, it's important, encouraging international cooperation to address a fragmentation across metrics and framework, and this is the objective of this report you find on our website if you haven't seen, so assessing net zero metrics for financial institutions, directed to financial institutions. Okay, there are important also other things that also for in terms of a business judgment rule, also of I would say strengthening rights and obligation, I would say, for having good corporate governance by companies. And it's important always, and in particular in financial institutions, in particular in insurance firms, that the corporate governance framework ensure really that the strategic guidance of the company, the effective monitoring of management by the board, and also the board accountability to the company as shareholder. We have seen last year, actually this year, the beginning of this year, some dramatic failures, not in insurance firms, but in banks in important countries. Among many other things, maybe dramatic failures of the basic corporate governance issues. The principles also, and this is again important for you, recommend that the board consider stakeholder interest when making business decisions in the interest of a company long-term success and performance, and in the interest of its shareholders. They also reflect the growing use of board committees while emphasizing flexibility in their establishment. Third, also they emphasize the responsibilities of the board, and again important for you, risk management, including for company groups and digital security risks. They also reflect important increasing diversity consideration in board composition and senior management, and recognize the value of gender diversity as well as very other important diversities. They also recommend the use of safe harbors for management and board member actions, such as I mentioned, the business judgment rule, and also provide some provisions in terms of recommendation. A flash, and then I close, Pamela, on pensions. The OECD also provide many more core standards and recommendation data analysis to support policymakers. And on private pension, as I mentioned earlier, asset-backed pensions are the biggest player in equity markets. And like with corporate governance, so sustainability consideration should play a crucial role on the market participant. We have our OECD core principles of private pension regulation. It's called the core principles. They already started emphasizing the importance of sustainability when they were last revised in 2016. The first core principle indicates that pension systems should have clear and well-defined objectives regarding sustainability. Another of the core principles provides that the governing body should consider and assess the sustainability of their investments. And moreover, as many of you know, the OECD Working Party of Private Pensions is currently revising the core principles, so with the aim to add more references to sustainability considerations. The revision includes ESG and sustainability integration in both ex-ante and ex-post investment practices of asset-backed pensions, so to maximize long-term outcomes for all private savings for retirement, but also society and the planet more generally. So in line with other international standards like the guidelines of EIOPA, of the International Organization of Pension Supervisors, on integration of ESG factors in the investment and risk management of pension funds, and with all the work that you are doing in the European Union. So we hope to conclude the revision next year, and we are very grateful to the many of you who have already been involved in the process, and Petra, really thanks to you and to EIOPA and also to many of the organizations also attending today. So we welcome further involvement by everyone. So to close, OECD instruments, including the revised G20 principles, but also the core principle of private pension regulation, underscore the importance of collaboration and adaptability in today's dynamic landscape. Commitment to sound governance and sustainability remains a cornerstone for enhancing consumer protection and securing, as also was mentioned before, financial stability. I think by addressing sustainability risk and fostering resilience, we can protect investors and ensure access to capital while contributing to economic growth and well-being of our society in the face of evolving challenges, as we say in our motto, better policies for better lives. So thank you really very much, and I look forward to today's discussion. And back, Pamela, the light to you.
Thank you very much, Carmine. It would be too difficult, I think, to sum up what you've said, and also you will not be addressed. You will not receive Q&A, but I think what we can take from your keynote is indeed the role of governance to promote stewardship, and not only to manage risks, but also manage stakeholder value. That is one sentence I would really take from this. But you started off with the important opportunities that SMEs should also be awarded in a time where actually the investment area is very concentrated. So we should not lose sight of opportunities to invest in SMEs. And I think that's also one of the core endeavors of the European Union. And we will look forward indeed net zero commitments. If the board makes a commitment, it has to follow up. We will read your paper with interest, and I think we will be facing much more discussion on transition plans and commitments. And indeed, we will continue to work also on the pension sustainability. We've given our advice on the EIOPS this year, and there is a lot that also pension investors, institutional investors can contribute. So I hope with that I give good credit to your keynote speech, and we look forward to continue engaging with you, and thank you very much for joining the conference.
Thank you.
Thank you, Alva. The next keynote speech, without further ado, we have Shigeru Ariizumi, Vice Minister for International Affairs at the Japan FSA, but also recently elected Chair of the EXCO at the IIS. Shigeru, the floor is yours.
Pamela, it's a privilege and a delight to be able to speak at this conference. First of all, I want to first express my sincere gratitude to EIOPA, particularly Petra, who has been a very close colleague of mine in especially the IAS, and we very much thank her for her very strong, superb leadership at EIOPA. Today, I just wanted to talk about, with two hats on, first about what we do in Japan as Vice Minister for the JFSA. Then I'll speak briefly about what we do at IAIS as Chair on sustainable finance issues. In Japan, first of all, we have been the G7 presidency for this year, 2023. And there were four priorities at the financial sector issues that we attached great importance. And one is about crypto, which I think that is a concern or interest for many of the supervisors around the globe. Then there were three others. One is the sustainability disclosure. The third one is about transition finance. And the fourth one is about natural disaster financing. So those are the four issues. And as you can see, there's three of them are actually related quite a bit with sustainable finance. I don't think I have to spend a lot of words about sustainability disclosure, but as all of you know, the ISSB has finalized the S1 and S2, and of course there were a lot the discussions with EFRAG about sort of ensuring the interoperability. But we very much welcome the progress in that space. For Japan, we also, for future work, we very much appreciate the importance of biodiversity, but we also are very much highlighting the importance about human capital in terms of the next step beyond climate for the IASSB. On transition finance, this is a concept that Japan has advocated for a fairly long amount of time, and I think that there's now I can say that there's probably very much of a broad consensus about the importance of transition finance. We think that it's important to sort of make sure that all sectors make their push towards net zero. And for that, we think that it is important for the financial sectors to engage with their client in order to make sure that will happen. And of course, from a financial stability perspective, this also makes sense because if your client, whether it's banking or insurance, is able to make the step towards net zero, from a bank's point of view, that would sort of mitigate their risks if their client adapts to the climate change risks. And also, if they are able to capture the opportunity, that will be much better as well. And for the financial institutions themselves, if they think about scope 3, it really does make sense that if their client do mitigate or decrease their carbon emissions. So your emission is my emission in terms of scope 3. So that's very important from the bank's perspective. And I think the same can be said with insurance as well. The more that your client adapts to the risks of climate, that will be much more easier for the insurers to actually insure those clients' risks tailored to their needs. So transition finance, I think, is a very important concept which has been supported at the G20 Sustainable Finance Working Group in a high-level principle. But the challenge here lies in about how do you actually operationalize, how do you actually accumulate real cases is the challenge that is ahead of us. And here it's actually, I won't go into detail, but actually sort of a public-private partnership, or typically, for example, blended finance could be quite important in trying to address the challenges posed by the transition moving forward. The fourth point we highlighted is about NatCat disaster risk. And this is something that we also put a lot of emphasis in the G7 process. And it actually, in the G7 communique in May, with the central bank and finance ministers have issued a communique there, they looked forward to the IAIS's work on NatCat protection gap. So this is not just about sort of a supervisor or regulator perspective, but it has received sort of a political attention. And I think that is also in the case of many jurisdictions, given the severity and the frequency of natural disaster that is actually happening. Another point, we are not a pension regulator, so I can't speak for pension itself, but related to this, we are actually in Japan promoting the concept of trying to be a leading center in the asset management space. And let me explain a little bit here. As many of you know, Japan has been in deflation for 3 decades, meaning that cash was king, so households saved, the corporates held on to cash. So if you add up what's in the household and the corporate sector together, in the household, actually the savings and deposit accumulates to around 7 or 8 trillion US dollars. And if you look at the corporate sector, it's about $2 trillion held in cash and in cash and deposit as well. So here we are talking about 9 or 10 trillion US dollars in savings. But as you may know, Japan's economy has been improving quite a bit recently. And we are also seeing signs that the inflation may be picking up, albeit it's not as acute as evident as it is in Europe. So people may be expecting some changes in monetary policies in the future. So in a sense, this is a timing for Japan to think about maybe encouraging household and corporates to go from savings to investment. So if that happens, if the money is put into work, then you want to make sure that the asset managers or the pension funds as asset owners maximize the return for the investment that is shifted there. So we have just announced a plan with leadership from the Prime Minister. The Prime Minister was quite committed to this yesterday. We announced a plan about how do we make the reforms here. And given that I think there's some pension regulators here on the call, let me mention briefly about what we do in terms of the pension funds or asset owners. First of all, we plan to ask them or to plan to sort of formulate a asset owners principle, which lays out what are the key responsibilities for asset owners. Because for until now, the asset managers or asset owners, because it was very much deflation and cash driven, there wasn't a very much thinking about to have a more sophisticated kind of asset management. So we are thinking about laying out sort of a principle to make sure that, and this is of course in collaboration with them, to make sure that they fully sort of understand what they need to do. And also we are also looking to improve the transparency of the pension funds in terms of their track record, in a sense. And that is also something that we are looking at. Another thing we are looking at for small pension funds who may not have the capability of managing the funds in a sort of a sophisticated way, we are thinking about perhaps aggregating them at specific institutions and mandating them to manage them on their behalf. So there are several initiatives in terms of pension that we are currently working on. Last but not least, let me put on my hat as the chair of the IAIS and talk about NatCat protection gap. This issue has been taken up at the IAIS, and a protection gap task force was established last year. And let me give great thanks to Pamela, who I was the chair, but Pamela was the vice chair. I didn't do much of the work; she did. So let me thank her very much for that. But the notion of taking up the NatCat protection gap was because this was also obviously related to climate. The second point is it's not just about advanced economies, but it's about emerging economies as well. And third point is about this, whether it's sufficient or not, there's data out there that you can sort of base your discussion on. So those are the reasons why we took up this issue. Of course, when we look at this, the insurance firms have a great role to play. They can, of course, cover the financial losses or the physical losses. And they can also contribute in terms of risk mitigation or adaptation. And they can, in a macro sense, they can provide sort of a buffer for the society as a whole. And that's where that's a critical role for the insurance. So there's clear role for the insurance to play in NatCat. But of course, there's a gap there. And what can the supervisors do here? And the supervisors challenge us sort of a difference in mandate. Because some only look at financial stability, some look at financial inclusion or market development, some put more emphasis on policyholders. So we needed to sort of go through this and to make sure that whatever mandate you have, that this could be important for you. So there's a narrative that we have put forward, and I think that was the challenge for us. Particularly, I think Pamela was helpful in this field to put together sort of a narrative that we can all go on board, regardless of the difference in our mandate. And here we have identified actually 5 points that we thought that would be important. Is the assessment of gaps and financial literacy, as Carmine mentioned. The third point is about how do you incentivize risk mitigation responses. The fourth is about how do supervisors can be helpful in enabling a more favorable environment to narrow down the gap. And the fifth one is about public-private partnership. And I think those issues are quite important in every aspect. But the importance from here is the report itself is not the end of the journey. It's only the start. And we would be very much interested in how can we implement. And implementation, I think, is the key here. And we need to gather sort of a strength from all stakeholders involved. And that is including international organizations such as the OECD, as Carmine has mentioned. And I think the OECD has a very much of an advantage, especially in the area of public-private partnership. And we also very much thank the IDF and the A2II to give us a emerging market perspective. But all in all, what is important here is it's not just about one insurer or one supervisor. It's about taking a multi-stakeholder approach. And we very much look forward to the EIOPA's work, as Pamela mentioned. As she said, stay tuned, I think. But we look forward to further collaborating with EIOPA to address this very important challenge. So thank you very much.
Thank you very much, Shigeru. And also no Q&A from you from the audience, but maybe also highlighting a few of the elements that you have actually mentioned in your keynote. Indeed, the importance of transition finance. I think this is becoming indeed an area of attention, which we all have to pay attention to more, and maybe also as supervisors. What I really liked what you said as a quote, it's very simple, but it's so true. Your emission is my emission. So let's not forget it. We can put it on a badge. Also, indeed, what you've mentioned, thanks to the G7 presidency of Japan, the political attention to natural catastrophe protection gaps, and ensuing from that, the mandates of the supervisors to really address that. And I think also what is worth lingering on later or thinking about on what you've said on actually the potential for investment, especially in your jurisdiction, in the asset management space. I see it as a huge potential, but I also understand the challenges that you're facing in trying to aggregate and have consistent investment policies also for smaller pension providers. So I think this has given actually a broader view also on what we're discussing in sustainable finance. And I hope we can also continue, as you say, in a multi-stakeholder approach. With this, I close the 3 keynotes, and I think it shows how EIOPA, the IIS, the OECD, and national jurisdictions across the world actually do collaborate. So to come back to the word Slido we had this morning, it is a matter of collaboration and aligning incentives and engaging at public and private level to actually meet the challenges of sustainable finance. So thank you very much, Shigeru, and looking forward to seeing you soon again. Goodbye. With this, we are at the first break of today. I hope you've enjoyed the keynote speeches. Come back after the break around 11:10, so 11:10, where we will then welcome Paul Tang for the Impulse speech. And I hope Paul will also be prepared to give us a bit of insight on the latest political discussions which we've read in the news, for example, on CSDDD, but also what is happening on Solvency II. So please do come back at 11:10, and then we can start again and resume with the Impulse speech and panel discussion before lunch. Thank you very much.